Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the Kagi chart, a unique and powerful charting technique that originated in Japan. This method has been used for centuries to simplify market analysis by focusing on significant price movements and filtering out unnecessary noises. By understanding how to use the Kagi chart effectively, you can enhance your ability to identify trends and make more informed trading decisions. So stay tuned as we explore the ins and outs of the Kagi chart and learn how to integrate them into your trading strategy. We're going to look, you have to watch till the end to let this be a comprehensive understanding, and you will see how to understand how to leverage this tool to potentially improve your trading outcome. We start by understanding what the Kagi chart is all about. Now the Kagi chart, you simply go to your chart area and select the Kagi chart. When you set this Kagi chart, this is what is going to display to you. The Kagi chart is used for trading, and you need to set up your chart with the appropriate parameters. This includes choosing the reversal amount, which is the minimum price movement required for a new line to be drawn. Now this can be a fixed amount or a dynamic measure like the average true range. The choice of reversal amount will depend on your trading strategy and the volatility of the market you are analyzing. So you simply go to your settings and set this. If you set the chart, it's already at its standard. It will be at ATR length at 14. So this is basically the standard. So let's see how we can implement this Kagi chart to our trading strategy. First of all, you set up your trading chart. Setting up your chart, you will need your chart with the appropriate parameters. This includes choosing a reversal amount, which is the minimum price movement required, and you will set your ATR, which is your average true range, to the standard measurement, which has already been set on my chart. The choice of the reversal amount will depend on your trading strategy and the volatility of the market you are analyzing. So we start by showing what this chart is all about. You can see how the chart is on my screen. After setting up your chart, you have to identify the trend from this chart. You try to identify the trend of the market, and as we can see, market has been trending to the upside. We can see it has been making its way to the upside in this area before the market decided to go on a sideways movement. You can see markets moved in a sideways movement for a while before it broke down to the downside, and it has broke back in, creating series of higher highs and higher lows in this area. So this is basically how to analyze your charts, looking at the broad market direction. When you analyze your trend direction, so let's make use of this area that price is trending to the upside. Once you have analyzed your chart, the next step is to identify the direction, which we have done. We look for a consecutive thick line that indicates uptrend in the direction of the market. You can basically use this charting pattern to indicate the direction. When you see consecutive thick lines, it's with the color, it indicates an uptrend. As we can see, consecutive green lines, green thick lines indicating the color of the chart. Then when you see consecutive thin lines, it indicates a downtrend. Consecutive thick lines indicates the uptrend, while consecutive thin lines indicates the downtrend. Remember, this is crucial because it helps you to align your trades with the prevailing market trend. So when you see consecutive thick lines or these green lines, it indicates a bullish market. When we see consecutive red lines or the thin lines, it indicates the downtrend. So how do we enter? We enter, our entry signals are generated when the trend changes. For example, if a thin line turns thick, when a thin line turns thick, in this area we can see this red line turned green in this area. Once it turns green, it indicates a bullish signal indicating potential buying opportunities. So once this particular green line turns to green, or we can say the thick line, the thin line turns to the thick line, it indicates buying opportunities. So at this point, when you see a change in color, you are looking to enter and capitalize on these trading opportunities. Conversely, if you are looking at a thick line and it turns thin, at this area when we are looking at a thick line, you can see this green side is showing us a thick line. The moment it turns green, this is our selling opportunity at that area. You can sell with this opportunity in that area. The fourth step is to confirm with shoulders and waist. In addition to the line thickness changes, the Kagi chart also forms patterns known as shoulders and waist. A shoulder formation is indicates a potential bearish reversal. The shoulder pattern, this is when you see probably your head and shoulder. As you can see in this area, we can see a simplified, this is the left shoulder, the head and the right shoulder. So the moment we see a shoulder, we can still decide to take a trade, a bearish trade in that area. When we see a shoulder form, it indicates potential bearish reversals. This is what it means. When we see a shoulder, not a head, a shoulder, when it forms, this is a typical example. When the right shoulder forms, we anticipate a bearish reversal, while a waist formation suggests a bearish reversal. This pattern can serve as additional confirmations to your trading setup. The next thing you need to know is when you enter your trade, where to set your stop loss. Remember, your stop loss is very important. Entering a trade is essential to always set your stop loss to manage your risks. For long position, you have to place your stop loss below the recent low. So if we enter a long position in this area, we set our stop loss below the recent low, and this is the recent low. As we can see, this is a recent low. This is where we set our stop loss. Then for a short position, we set it above the recent high. We set our stop loss just above the recent high of that area. This helps us protect our position from unexpected market movement. It helps us protect our position from unexpected market movement. Then the next thing we need to know is where we can set our take profit. And finally, we have to define our take profit target based on previous swing highs and swing lows. In this area, in this buy trade, we can go for a swing high. This is a previous swing high in this area. We can use this particular area to define our take profit region. We can take our profit in this area. In this area, this can be a good place. We can also take our profit in this other area. Depending on what you choose, you can go for the nearest swing high, or you can go for a more comfortable swing high, or you can go for a fixed 1:2 swing high, as the case may be. This opportunity, we have to go back far back in time to mark out our previous swing high to get this selling opportunity. If we do not see a swing high that is far back in time, we can basically go for a fixed risk to reward of 1:2, 1:3. 1:2, 1:3. This is what we can go for to help us set our stop loss at this area, our take profit rather at this area. Another approach is to use the trend line break rule, where you exit your trade when trend changes, when three consecutive line forms. This strategy can help you ride the trend while minimizing exposure to trend reversal. So the moment you see a trend line, this can be an area where you would want to exit your trade. The moment you see a trade line, this is first line, second line and the third line. Once you see the first line, second line and the third line, this can be a potential area that you want to exit the chart. You can also exit your trade the moment you see a change in color, or the thickness levels. When you see in a buy trade, we are trading the thickness. When you see a thin line, you can exit your trade. In a selling position, when you see a thick line, you can as well exit your position. This strategy helps you to ride the trend while minimizing exposure to potential risks. So this is basically how we can capitalize on this strategy. So basically, if you want to enter a trade, a buy trade at this area, you wait for the price to change to the thick line or the green line. You set your stop loss just below the last swing point. Even if price came back down to this area, we were safe because our stop loss is in a reasonable area and we take our profit at a previous high area. The same as a selling position. If you are to take a selling position from this area, the moment our line changes its color or it changed to a thin line, you enter the trade, you take your stop loss just above the previous swing high and you ride the trend to the next swing low or till the exact moment it changes its line to a thick line or a green line. This will be your confirmation to exit and capitalize on your existing profit that you have gotten from the trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you would never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.